How to Invest in Stocks for Beginners 2024. Are you interested in investing in stocks but unsure of where to begin? You're not by yourself. Especially if you're just starting out, investing in the stock market can be a scary idea. Those who are new to investing frequently believe that buying stocks requires thousands of dollars and a degree in economics. However, starting doesn't have to be costly or difficult. Whatever your budget, you have a plethora of options when it comes to investing, even though there are thousands of tactics and nuances to understand about the stock market. You can start modest and easy with $100, $10, or even $1 with online brokerage accounts, as well as investing alternatives like fractional shares and exchange-traded funds. Then, as your income grows, you can raise your investments to match your specific investing goals by gradually building up your portfolio. Reasons to invest in stocks. Why do individuals make stock market investments? The two main goals of most investors are to increase their wealth and stay ahead of inflation. Investing in stocks has certain alluring benefits. Return on investment. Gains in stock prices and dividends are the two primary ways that investors might recoup their investment. You receive extra payment when shares sell for more than you paid for them, and certain stocks continue to pay dividends annually despite fluctuations in stock price. Complementing. Compounding is the process of gaining more interest or returns on your initial investment. Even if you're not adding fresh funds to your account, your money will compound and grow for you when you use your investment profits, dividends, and interest to purchase more shares. Investing your income rather than spending it will increase your potential for wealth. To learn how it operates, try the compound interest calculator on Stash. Preparing for retirement. People frequently choose investing as their primary method of retirement savings. Investing can help you reach your retirement savings goal by increasing your money more quickly than storing it in a conventional savings account or stuffing it under your mattress. It also has a long timeline, tax-advantaged retirement plans, and compounding. Long-term financial stability. The stock market has historically returned 10% annually on average, which means that over time, its earnings may exceed the interest you could receive from a savings account. Furthermore, if your stock returns match or exceed the rate of inflation, you won't lose purchasing power when you cash out your investments later. What are your financial goals? Individuals invest for a variety of short and long-term objectives, including reaching milestones like home ownership, retirement, and meeting educational costs. Your financial goals will influence your schedule, level of risk tolerance, and investing approach. How much risk can you take? Stock investing is not without danger. The stock market is erratic, with individual equities and industries experiencing varying degrees of price volatility. Thus, it's critical to comprehend your risk profile or how comfortable you are with various risk levels in relation to your age, income, and time horizon for investing. To what extent do you intend to invest? Your goals will determine a lot of your investing timeline. What is your distance from retirement? When would you like to purchase that home? Your time horizon will be. Because you have more time to recover any losses from stock market swings, longer time horizons enable more aggressive investment techniques. Do you have confidence in your emergency savings? Creating an emergency fund should be a key component of your overall financial strategy. Your emergency fund enables you to pay for major, unforeseen bills without depleting your stock assets, such as when your car breaks down or your water heater leaks. In this manner, you can avoid worrying about short-term capital gains taxes or having to sell stock while the market is down. If you have debts with high interest rates, you might be paying more in interest on your high-interest debt, such as credit card debt, than you are on your earnings from investments if you invest on a regular basis. Therefore, pay off high-interest debt as a priority before concentrating on your investing plan. 6 steps to stock investing. Now that you understand the why, it's time to discuss the how. The next 6 steps will guide you through the basics of stock investing so you can get started right away. Decide on your investing approach. Select an investment account. Determine your investment budget. Select the stocks and funds to invest in. Establish a timetable and make monthly investments. Keep an eye on and manage your portfolio. 1. Decide what kind of investor you want to be. Determine the type of investor you are before you begin selecting particular stocks and funds for your investment portfolio. This will assist you in formulating your plan and determining the level of involvement you wish to have in your daily investing choices. Think of inquiries such as these. Asterisk, are you interested in becoming a passive or active investor? Asterisk, to what extent do you wish to be in charge of your investments? Asterisk, to what extent are you at ease with risk? The do-it-yourselfer and the set-it-and-forget-it investor are the two main categories of investors, notwithstanding the abundance of investing techniques. 2. Create an account for investments. You can't usually buy stocks directly from the stock market. Instead, a regulated brokerage executes trades on your behalf. Brokerages come in many different forms. App-based online brokerages with algorithm-driven robo-advisors, DIY online brokerages with minimal features, and traditional brick-and-mortar organizations with human financial advisors. The kind of brokerage you select will depend on how you invest. 3. Determine the amount you want to put into stocks. Everybody has a varied set of circumstances, earnings, and available funds. As such, the amount that you should invest will range greatly among investors. Generally speaking, if you're saving for retirement, experts advise investing between 10 and 20% of your income. Investing what you can afford to lose is a more practical solution, though. Thanks to fractional shares, which allow you to acquire just a portion of a share, you can start buying stocks with very low money. Whether you have $10 or $1,000 to invest right now, even tiny amounts made over time will add up. 4. Select the stocks and mutual funds you want to buy. It's time to buy stocks now that you have a budget and know where you're investing. Investment options include mutual funds, individual stocks, bonds, and exchange-traded funds. Each has advantages and disadvantages that vary depending on the investor's level of involvement, costs, impact on diversification, and risk versus reward. 5. Establish a timetable for your investments and stick to it. After opening a retirement account or brokerage account, you can make an investment schedule and strategy. Many prefer to invest weekly, bi-weekly, or monthly based on how frequently they receive their paychecks. Even if you don't have a large amount of money to invest initially, this helps you develop an investing habit and gradually expand your portfolio. You can avoid physically moving money by automating your investments using payroll deduction or an app, which will help you stay on schedule. You can also take advantage of dollar cost averaging, which automatically buys more shares of a stock at low prices and fewer shares at high prices by setting aside a certain amount of money to invest at regular intervals. In order to have your dividends automatically reinvested in additional assets, you can also opt to engage in a dividend reinvestment program or DRIP. These two methods assist with passive investing, which allows your money to increase without requiring a lot of active management on your part. 6. Monitor and track your portfolio. As an investor, you should keep track of your portfolio's performance over time. Because stock prices change frequently, checking in every day could make you more anxious. However, periodic reviews can assist you in ensuring that your investment plan remains in line with your objectives. A few times a year, evaluate your progress by giving yourself a money date. The whole point of long-term stock investing is to factor in the unavoidable ups and downs, so don't freak out if the value of your investments occasionally drops. Ready to invest in stocks? Starting a stock investment doesn't have to be as challenging as it might first appear. You could determine your investing style, risk tolerance, and goals with some introspection. After that, opening a brokerage account and beginning your investment career is rather simple. You have a plethora of options when investing with Stash, such as fractional shares, which let you start buying stock regardless of your investment amount, ETF options, which automatically diversify your portfolio, and smart portfolios, which assist you in selecting the ideal portfolio for your particular requirements. The earlier you start investing, the more your money grows. Would you like it? Hit the like button and subscribe to our channel for more interesting and informative videos.